Investing isn't just about picking stocks, it's about having a clear strategic plan. In this video, we'll teach you how to build an investment thesis like a pro. Discover how to research companies, evaluate risks, and define your unique investment rationale to make smarter, more confident decisions. Today, we will talk about how to build an investment thesis like a pro. So before we get started, make sure to hit that like button, also subscribe to my channel. Understand what an investment thesis is. An investment thesis is more than just a statement. It's a well-reasoned framework that explains why an investment makes sense. It's your personal blueprint that connects research, analysis, and your financial goals into one clear idea. Many people invest without one, leading to impulsive decisions based on hype or emotions, often resulting in losses. Professionals use their thesis as a filter, helping them say yes only to the investments that meet their criteria and no to distractions. Your thesis becomes your compass, especially when markets are volatile or when news tries to shake your confidence. This foundation is essential if you want to build a consistent, successful investing practice. 2. Define your investment goals clearly. Clear investment goals are the backbone of any good thesis. Are you investing for retirement decades away, looking to generate passive income, or saving for a big purchase like a house? Each goal demands a different approach and risk tolerance. Long-term goals allow you to take more risks for higher potential gains. Short-term goals require safer investments to protect your capital. 3. Research the company or asset thoroughly. Research is the heart of a strong investment thesis. It means digging deep beyond headlines or social media hype. Look into the company's history, its products, leadership, competition, and financial results. Read earnings reports, listen to conference calls, and follow credible analysts. The more you understand the business model, how it makes money, and what drives growth, the better your thesis will be. 4. Analyze the industry and market conditions. Understanding the environment in which a company operates is just as important as knowing the company itself. Industries go through cycles, trends, and disruptions. A strong thesis considers these factors because they affect growth and risk. For example, investing in a coal company during the global push for renewable energy carries different risks than investing in a renewable energy firm. Look at industry growth rates, barriers to entry, regulatory pressures, and technological changes. Who are the key players? How intense is competition? What innovations could change the market? This big picture view helps you decide if the company you are interested in is positioned to grow or if it's fighting an uphill battle. Market conditions also influence investment timing. Even great companies can see their stock prices fall in weak markets. Understanding when to invest requires looking beyond the company to the health of the economy, interest rates, and investor sentiment. Your thesis becomes stronger when it includes a clear view of the environment your investment is operating in. 5. Identify the competitive advantage. Competitive advantage is what separates winners from losers. Also called a moat, it's what protects a company's profits from competitors. It might be a brand name, proprietary technology, exclusive contracts, or cost advantages. Without a moat, companies can be easily overtaken, making investments risky. Your thesis should explain why this advantage exists and how long it can last. For example, a company with patents on life-saving drugs has a strong moat, but only as long as the patents hold. A retail chain with a loyal customer base and prime locations might have a different kind of moat. 6. Evaluate the financial health and valuation. Numbers don't lie, but they can be misinterpreted. Evaluating a company's financial health means looking closely at income statements, balance sheets, and cash flow statements. Strong revenue growth, healthy profit margins, manageable debt, and positive cash flow are signs of financial strength. They indicate the company can weather storms and invest in opportunities. Valuation is about price versus value. Even the best company can be a bad investment if you pay too much. There are many ways to value a company, like price-to-earnings ratios, discounted cash flows, or book value comparisons. Your thesis should explain why the current price makes sense for the potential future profits. Overpaying can lead to poor returns or even losses, no matter how good the company is. Being patient and disciplined to buy at the right price is a key skill professionals have. A solid thesis balances financial health and valuation to find investments that are both good companies and good deals. 7. Consider risks and how to manage them. No investment is without risk. Good investment theses are honest about what could go wrong. Risks might include economic downturns, increased competition, legal problems, changes in consumer behavior, or technological disruptions. A strong thesis doesn't just list risks but also includes plans to manage them. For example, you might decide to limit how much you invest in one company or sector. You could set stop-loss orders to sell if the price drops too far. Or you might diversify your portfolio to spread risk. 8. Determine your time horizon. Your time horizon shapes your thesis and your patience. Investing for the short term requires a different approach than investing for decades. Short-term investing might focus on quick gains but comes with higher risk and stress. Long-term investing allows you to ride out market ups and downs and benefit from compounding growth. Knowing your time horizon helps you choose investments that match your patience and goals. It also helps you avoid reacting to short-term noise in the market. A professional thesis includes a clear understanding of how long you plan to hold and why. This clarity supports steady decision-making and reduces the temptation to chase quick profits or panic sell. 9. Plan your entry and exit strategy. Having a plan for when to buy and sell is essential. Many investors fail because they buy without a clear entry point or sell based on emotions. A professional thesis includes conditions that must be met before investing, like a target price or market condition. It also defines when to exit, whether it's reaching a profit goal, changes in the company's fundamentals, or hitting a stop loss. This plan helps you stay disciplined. You won't hold on to a losing investment hoping it turns around, nor will you sell a winning investment too early out of fear. Entry and exit strategies turn investing into a science rather than guesswork. They protect your capital and lock in gains systematically. 10. Review and update your thesis regularly. Markets and companies change. Your thesis should not be static. Reviewing and updating your thesis regularly is crucial for long-term success. New information like earnings reports, industry shifts, or economic changes can affect your investment's outlook. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.